Okay. Good morning, everyone. Good morning, Manini. Good morning. I think that my camera is not visible. It's flickering, but hopefully it should start in a couple of minutes. Okay, so I thought let me at least start the session. The camera will be a little, that's a technical issue, but I think we can adjust with that. Okay, so coming back to our topic in days 12, where we are dealing with deferred taxes. Yes, good morning, Soham. Good morning, Shailendra. Good morning. Good morning. Okay, so in the previous class, what we have seen was deferred taxes. We first introduced why the standard was required, because we are getting a mismatch in the tax expense that I'm going to incur vis-a-vis the accounting profit that I am earning. This differences arise because tax expense is recorded in accordance with the various provisions of the tax laws which are applicable in the particular case. So those provisions of tax laws could give rise to certain differences, and those differences are what we take into our deferred tax workings. Okay, is deferred tax an actual cash outflow or cash inflow? Answer is no, it's not. It is a mere accounting treatment. Over the period of time, these deferred taxes will ultimately start to get reversed. Okay, and ultimately it will tend to what is my accounting profit. So that is what we had studied. Then we moved on to understand what is a tax base and what is the accounting base. Or carrying amount. So carrying amount is essentially the ledger amount, that is you apply Ind AS and arrive at the balance sheet value of each asset or liability. The tax base is the amount attributable for tax purposes for that respective asset or liability. So we either saw that, so if I have to define tax base of an asset, the tax base of an asset is the amount deductible against the income that will be generated from that asset, provided the income is taxable. If the income is exempt, tax base is equal to the carrying amount. So this was what we had discussed. Am I right? Yes, I think so. This is what we had discussed. Yes, compute the tax base. All right. If it is non-taxable, the tax base equals the carrying amount of the asset. Yeah. So what is the tax base of a liability? It is the carrying amount minus the amount deductible for tax purposes in future. Okay. So these were the things that we saw. We also discussed how the questions we could do. We could either interpret it as having two sets of accounts, that is one is your tax records and one is your accounting books. Pass the journal entries and actually see what will be your tax base and what will be your accounting base, or what you call as the carrying amount. So in most of the cases they may be the same, but in some cases you could be having differences, and these differences are taken to be my we have to categorize them as temporary differences or non-temporary differences. So if I have my temporary differences, I will classify them as taxable temporary differences or deductible temporary differences. Taxable gives rise to a deferred tax liability, whereas deductible gives rise to a deferred tax asset. Okay, so we also saw that a similar concept is there under AS 22, where the term used there is a timing difference. Here we use the terms temporary difference. Then we came up with a rule saying that if carrying amount is greater than the tax base, you see what is the underlying. If it is an asset, then what you will be creating is a deferred tax liability. You remember this one relationship, automatically the other three relationships you will be able to understand. And with that, I had left you with a number of examples for homework. What you have to tell me is, did you guys try those examples, or are you facing any difficulties in those examples, or I can proceed further? Hi, good morning, Viraj. Kaushiki is not around. Yes, she's there. Okay. So, are you okay with the examples, everyone? Did you try honestly? Did you honestly try the examples? Yes. Soham. Okay, no difficulty. Manini also confirmed no difficulty. We can proceed. Great. So that completes a major chunk of our deferred tax assets liabilities recognitions. Okay. Now we have completed 4 out of 10 steps. So we are having remaining 6, but we've covered in terms of what you can say in terms of the quantity, we've covered major portions. Now we are having identifying exceptions, which tax rates to use, all that, whether offsetting is permitted. These are the smaller nitty-gritties of Ind AS 12. So now we move on to identifying. Okay, so Kaushiki has an example has a problem in example 30. Okay. Okay, fine. I'll discuss this. This is all related to business combinations. Okay, fine. I'll discuss this. Don't worry. Okay. We'll discuss this. I'll come to that surely. Okay. All right. So coming to deferred tax assets or liabilities for goodwill arising in a business. So now we proceed to looking at the exceptions. You got the tax base, you got the carrying amount, you got the differences, and most of the cases you went on to do the deferred tax computations. But wherever there are differences, in all cases, we will not be recognizing the deferred tax asset or deferred tax liability. There are some exceptions. Why these exceptions are there? Let us understand. So first case is recognition of deferred tax asset or liability for goodwill that arises in a business combination. Okay. So unfortunately, I only taught you Ind AS 103, that is goodwill. So all of us know why goodwill is arising in a business combination. It is because my purchase consideration which I have paid is higher than the net assets that I have acquired, the identifiable net assets. The difference is what is your goodwill, which we take into the consolidated financials. Now, tax authorities or tax department does not recognize the concept of consolidated financial statements. उनको समझ में नहीं आता है. At least in India, what they do is they assess the entities independently. So each of the parent and its subsidiaries are having their own PAN numbers and their assessments happen separately. The group assessment is a concept which is not there as far as the tax department is concerned. So clearly this goodwill will not be visible for the purposes of tax profits. The goodwill is not tax deductible. That means what? In future, if I impair this goodwill, I'm not going to get a deduction for that. I'm not going to get a deduction for the excess amount paid because I don't have the concept of consolidation in tax purposes. It is not even deductible when subsidiary disposes of the underlying business. So for all practical purposes and theoretical as well, the tax base of goodwill is going to be 0. The tax base of goodwill is going to be 0. Whereas carrying amount will surely be there. So clearly there is a carrying amount, there is a tax base which is 0. So carrying amount is always going to be greater than the tax base because tax base is always going to be 0. So even if carrying amount is 1 rupee, the carrying amount is greater than the tax base. So what is the rule? Carrying amount is greater than the tax base. We are checking for goodwill, and goodwill is an asset. And this asset means what we will have to create. Ideally, we should have created a deferred tax liability. Ideally, we should have created a deferred tax liability. But what the standard says is do not create a deferred tax liability. Do not recognize DTL. Why am I not going to recognize the DTL? We can understand with the help of an example. Okay. See, very simple example. Purchase consideration is 100. Net assets acquired is 120. So what is the journal entry you will pass on consolidation? What is the this thing you will pass on consolidation? Entry will be net assets account debit 120 to bank. Sorry, I have to make it the other way around. I'm talking about goodwill. 120, 100. My mistake. Okay. So this is 100. You are paying 120. So the difference gives rise to goodwill. The difference gives rise to goodwill. Now, if this goodwill is there, ideally, I should have created a deferred tax liability. Why? Carrying amount is greater than the tax base. Carrying amount is 20, tax base is 0, underlying is an asset. So what I should be creating is a deferred tax liability. Assuming the tax rate is 30%, what happens is, fine, let us proceed to calculate. So now, forget the exception and now you proceed to calculate. What you are going to get is to deferred tax liability 20 into 30%. So that gives you 6. If this becomes 6, what is going to happen? This will become 26. But now what you will do? Sir, up to 26 ho gaya. Abhi if it is 26, then you will again make a change. 26 into 0.3. So this will then move on to become 7.8. Then what will happen? This will become 27.8. Then you again move further and then what you do? You again calculate 30%. It will become 8.34 plus 27.8. ऐसे करते करते what will happen is you will never come to an end because it is always moving on the upper side. The deferred tax impact which you are creating on this goodwill is being absorbed in the goodwill itself. And because it is being absorbed in the goodwill, between goodwill and the deferred tax thereon, we come up with a never-ending circular reference. We are going to come up with a never-ending circular reference. And because of this reason, the standard gives you the exception saying that never recognize the deferred tax in respect of goodwill. Alternative capital reserve, then also you will not recognize. Okay, so whatever, whether it is goodwill or capital reserve, you are not going to recognize the deferred tax impact because it results in a never-ending circular reference. See, it's not coming down. The deferred tax is going on increasing. So the goodwill component goes on increasing and they are mutual. That means one increases, the other also increases. So you are going around in circles. So that is why you are having an exception. That is why you are having an exception. The reason is circular reference. The reason is circular reference. On initial recognition of goodwill, relating to initial recognition of goodwill. So what does this mean? Relating to initial recognition of goodwill. See, in consolidation, we had done a case where the goodwill gets impaired. We had done the case where the goodwill gets impaired. Now, the goodwill was recognized in the carrying amount of your the goodwill was recognized in your accounting records, but this goodwill was not there in the tax base, in the tax records, तो उसका impairment भी नहीं होगा. So there is an impact. There is an impact of impairment in accounting, but there is no impact of impairment in tax because there is no asset in the first place. So therefore, this impairment is pursuant to an initial recognition of goodwill. And because there is an initial recognition of goodwill exception, therefore, impairment loss is also not going to have any deferred tax implication because it is having a direct relationship with my initial recognized goodwill, with my initially recognized goodwill. So these are the two exceptions. Suppose the goodwill is deductible under tax purposes. In that case, go ahead and recognize the corresponding deferred tax liability. Are you okay with this exception? Are you okay with this exception? Yes. Good morning, Sanjay. Good morning. Are you okay with this exception, everyone? Why am I not recognizing the deferred tax on goodwill? Is it clear? Yes. Everyone, is it clear? All right, so Manini confirmed, Soham has confirmed. Okay, so now let us proceed with the examples which are there. This is from your study mat. An entity acquires a subsidiary and pays 1 lakh. Fair value of net assets is 65,000. So what is the goodwill? Goodwill is 35,000. Tax rate is 30%. Okay. How should the entity deal with the taxable temporary difference? It is giving a difference arising on initial recognition of goodwill in a business combination in a tax jurisdiction where such goodwill is not tax deductible. So what are you going to do? You are going to ignore this goodwill. You are going to ignore this deferred tax implication because it is in relation to it, because it is arising on recognition of goodwill. It is arising on recognition of goodwill. Moving on to the next one. After 2 years, this goodwill is tested for impairment and the entity recognizes an impairment loss of 10,000. So what is the treatment of the amount of taxable temporary difference? In this case also, do not recognize. Do not recognize. Why? जब goodwill के ऊपर हमने recognize नहीं किया, when we did not recognize it on the goodwill, we will not recognize the deferred tax on account of impairment also. So here you will not recognize the deferred tax impact. Acha. Which brings us to one more case. See, what I told you was ideally accounting profit multiplied by tax rate. This should be your tax expense. And if this is your tax expense, my tax expense as defined is current tax plus deferred tax. My tax expense is going to be my current tax plus deferred tax. Current tax, though, we are able to calculate, no problem. But when I'm calculating my deferred tax, we are going to face certain exceptions. And because we are going to face certain exceptions, like, for example, penalties. In respect of penalties, you will not record a deferred tax because the penalty amounts are never going to reverse in the future. It is a never allowable expenditure under the tax laws. So penalties are not going to be a temporary difference. It will be a permanent difference. Okay. So my point is, there will be some exceptions to deferred tax. And because of that reason, the accounting profit into tax rate equal to tax expense will always not be true on account of these exceptions. So what will happen is there will be a reconciliation which will be given for these particular reasons. There will be a reconciliations. And once you start working on the reconciliation, that time all your exceptions, the difference, all your exceptions will come as a matter of reconciliations. Okay, so anyways, that we will see later. We have a new RTP question on that, so I will run you through that question as well. Okay, so now let us move on to the next one. This is taken from Test Your Knowledge, but a similar question has also come in your RTP. Okay, very quickly let us do this. It will not take much time. Okay, A Limited acquired B Limited. The following assets and liabilities are acquired in a business combination. So plant and equipment, you are given fair value, carrying amount and temporary difference. Okay. You see one missing information. What is the missing information here? What is the missing information here? Sir, the missing information is tax base diya hi nahi hai. There is no tax base. So here in this particular case, it is implicitly assumed that tax base equals the carrying amount. ये implicit assumption है. उन्होंने दिया नहीं है, but it is implicitly assumed that tax base equals the carrying amount. Otherwise, you cannot solve this question in the first place. Okay. So fair value of plant and equipment, inventory, debtors is given. carrying amount is given, temporary difference is given, 9% debentures. So these are my net assets. These are my net assets. Okay, 470, 495. Consideration paid is there, and the goodwill also you are getting of 25. Okay, the net goodwill is coming to 25. So now the question is, calculate the deferred tax asset. Calculate the deferred tax asset. Sir, this reconciliation is done for financial reporting purposes. Tax mein to we don't even know what is deferred tax. Okay, so there is no place where you have to do the recognition, where you have to present the reconciliation for tax purposes. Okay, Kaushiki, temporary differences comes because carrying value is not equal to the tax base. Yes, yes, that is a difference. Okay, that is a difference. All right, so now let us proceed to calculate. So what am I going to look at? Well, I am going to look at what is the net assets which I have acquired. Well, the net assets which you have acquired is at these values: 250, 120, 200 and 100. Okay, so these are the values at which you have recognized the net assets. Consideration paid is there. So if I have to pass a journal entry for this, the journal entry will look something like this. Okay, plant and equipment debit, that is 250. Inventory debit, that is 120. Debtors debit, you are taking these individual assets one by one. So debtors debit 200. Leave about 2-3 lines to 9% debentures. This is going to be 100. To bank 500. Okay, now that is the only assumption you can make, Kaushiki. Otherwise, I cannot record this. I cannot record this. I cannot solve this problem. Okay. So now this in fact becomes your carrying amount. It is this figure, the fair value, which becomes your carrying amount. And the existing carrying amount is going to be assumed as tax base. The existing carrying amount is going to be assumed as your tax base. So fair value is the carrying amount because you are taking over the assets and liabilities at fair value. So that is your carrying amount. Because the tax base is not given, the existing carrying amount has to be assumed as your tax base. So now look at this figure. Look at this figure. Carrying amount is lower than the tax base. If carrying amount was higher, the relationship is inverse. If carrying amount is lower, the relationship is direct. So carrying amount is lower than the tax base. That means what? The difference is 25. That means carrying amount is lower than the tax base of the underlying item. What is the underlying item? The underlying item is a net asset. So what are you going to create? Sir, I will be creating a deferred tax asset. They have given you create a deferred tax asset, but if they had not given this, then also a deferred tax asset is going to be created. Acha, what will be the deferred tax asset which you will create? 25 into 30%. इसमें tax rate दिया नहीं है. Assume rate as 30%. Okay, so 25 into 30%, I am going to create a deferred tax asset of 7.5. I am going to create a deferred tax asset of 7.5. So now you will be having DTA, debit 7.5. And now you proceed to calculate the goodwill. Now you proceed to calculate the goodwill. Goodwill is going to be how much? This is 600 minus 450, 150 minus 120. Ideally, it would be 30, but because I'm recognizing a DTA, the goodwill comes to 22.5. The goodwill comes to 22.5. Will I recognize a DTL on this goodwill? Answer is no. Why no? It is initially recognized. It will give rise to a circular reference. So I will not recognize a DTL in respect of this goodwill. Is it okay? Have you understood the question? Yes. Soham, is it fine? Sanjay, is it fine? Shailendra, is it fine? Viraj, is it fine? Did you understand the question? Have you understood the question? Yes. Sure. All right, great. So that takes care of this question. Let us then move on to the next question. Similar data is given. Similar things are there. Only thing is what you will have to now compare is you are having the tax base. You are having the tax base. So therefore, your comparison has to be different. Okay. So now quickly go through this question. I'm giving you 2 minutes. I'm giving you 2 minutes. Tell me what is the DTA or the DTL that you are going to recognize. What is the DTA or the DTL that you are going to recognize? Cheating mat karo, RTP mat dekho. Okay. Don't look at the RTP. Don't look at this thing. Please look at what am I going to recognize as a DTA or as a DTL. Okay, come on, go ahead. Quickly, 2 minutes. Sir, rate दो है, the rate we will look at that later. सबसे पहले we are having 3 figures now. Important is कौन से दो लेने हैं अपने को. And what is the temporary difference coming to? Correct. So go ahead. You are right, Kaushiki. So batao, what is my temporary difference? Manini, 150, is it the DTL or is it the temporary differences arising? Soham, did you get? Okay, great. So what am I going to ignore is my book values. I'm going to ignore this because I'm not recording it based on the book values. My carrying amount will be based on the fair values because it is a business combination. So fair enough. So if you look at the net assets acquired, for the tax base, it will be 500, 200, 700, 800, 1080 minus 160. So tax base is equal to 920. tax base is 920. Fair value is your new carrying amount. So that comes to 1070. So your difference is going to be 920 minus 1070. Your difference is going to be 150. Your difference is going to be 150. Anybody who got this, excellent. So far you are correct. Now the problem arises is I am given two tax rates. The tax rate in HS jurisdiction and the subsidiaries jurisdictions are 30% and 40% respectively. So my question is, which rate am I going to take? Will I take the 30% rate or will I take the 40% rate? Will I take the 30% or will I take the 40% rate? Okay. No problem. No problem. I came to know it was a mistake. Okay. So which rate am I going to take? Will I take the subsidiaries rate, which is 40%, or will I take the parent jurisdictions rates where the rate is 30%? See, these are the taxable differences. These are the temporary differences which are arising in respect of the net assets of the subsidiary. These are the differences which are arising in respect of the net assets of the subsidiary. Net assets of subsidiary are located in the subsidiary's jurisdiction. And because the net assets of the subsidiary is located in the subsidiary's jurisdiction, the tax recovery or tax liability will be paid in the subsidiary's jurisdiction, not in the jurisdiction of the parent. And because the recovery or payment happens in the subsidiary's jurisdiction, we are going to take the subsidiary's tax rate and not that of the holding company. That is, we are going to take the 40% tax rate. 150 into 40% is 60. See, ideally I should have taken 30% because I am preparing consolidation books, consolidated financials. But look, I have an asset. Understand it this. Okay, forget an asset. You are operating, say, in India. You have a subsidiary, let us assume in Sri Lanka. You have a subsidiary in Sri Lanka. The gratuity amount that you are providing in the books is going to be allowed on a payment basis, whether it is in India, whether it is in Sri Lanka. So the gratuity amount was provided by your subsidiary in its books of accounts in Sri Lanka. So that will be disallowed, and on that you are going to pay the tax at which rate? At India's rate or at Sri Lanka's rate? Sir, you are going to pay the tax on Sri Lanka's rate. So in future, when you pay the gratuity which you have disallowed today, that gratuity will be allowed as an expense in whose books? In the subsidiary's books. At which rate? At the Sri Lankan tax rate, which is based in Sri Lanka, because the subsidiary is based in Sri Lanka. So when I do the consolidation, I take these taxable temporary differences, but whose rate will I apply? I will apply Sri Lanka's rate, because the recovery of tax or the excess payment will happen based on Sri Lanka's tax rate, because the jurisdiction of the subsidiary is in Sri Lanka. So for same reasons, in this case, the subsidiary's tax rate is what we are going to consider, and that is 40%. So I am going to recognize 60. I am going to recognize 60. The question is, sir, what is this 60? This 60, is it a deferred tax asset or is it a deferred tax liability? So very simple. Compare the carrying amount. Sir, the carrying amount is 1070. Tax base is 920. Carrying amount is greater than the tax base. And because the carrying amount is greater than the tax base of the underlying, what is the underlying? Net assets. Net assets. So what am I going to create? I am going to create a DTL. I am going to create a DTL of 60. So what is the journal entry that you will pass? Well, I am going to pass the entry net assets debit 1070 to bank. You are acquiring 100% share capital for 1500. 1500 to deferred tax liability. How much is that? That is 60. That is 60. So 1560 minus 1070, you are having 490. This is nothing but goodwill. This is nothing but goodwill. All right. So that takes care of your question. That takes care of your question. Okay. All right. Everybody, is the question clear? Is the question clear? Okay. So when you solve this question, please make a habit that you will explain the questions, the provisions of the respective Ind AS, saying that this is relating to acquisition. You will have to explain couple of things. Number one, why you are not considering the carrying amounts. So that is one point. So you are comparing tax base and fair values. The temporary difference, you have to tell that it is a taxable temporary difference. And later on, you will have to explain why you took a 40% tax rate and not a 30% tax rate. And finally, you will have to do the calculation. So in CA final, calculation is not everything. You have to be sure that you explain the provisions of the Ind AS. See, Ind AS constitutes a very, very significant part of your paper. I suppose it's nearly 90 to 96 marks which you are going to get only on Ind AS. बाकी वो छोटा-छोटा questions है on corporate social responsibility, etc. वो आपका नसीब है. But I can say that at least 90 to 96 marks will come purely from Ind AS. So you should exhibit your expertise in Ind AS. Okay. And make a habit of writing the points related to the question by referring to the respective standards. That is going to create a positive impact on your examiner. Okay, so we did this also. So now that part is done. So relating to business combinations, goodwill, we are done with the discussion. Okay, so now coming to the next part, exceptions only. Temporary differences arising on initial recognitions of an asset or a liability. Okay, a temporary difference may arise on initial recognition if part or all the cost of an asset will not be deductible for tax purposes. Will not be deductible for tax purposes. All right. See, once upon a time, Indian tax laws did not permit any deduction for a foreign vehicle that was purchased. This was to primarily ensure that imports were, imports were discouraged. So we were having a balance of payments deficit, etc., etc. So that point of time, this is prior to 1990s. If anybody had to import a vehicle like a Mercedes or a BMW at that point of time, then depreciation on that was not allowed. Depreciation on that is not allowed. Okay. Sir, earlier we do entry of DTE expense, deferred tax expense or deferred tax liability. Okay, deferred tax expenses account debit to deferred tax liability. But here the balancing figure is goodwill because this is business combination, Kaushiki. This is not a regular case where I'm taking the profit and loss and passing the entry. This is a business combination. So the business combination this is the first time I have acquired the entity. No other transaction has happened. So just imagine if in the balancing figure I take deferred tax expense, how will it look like? My consolidated P&L is showing 0 because this is the first day of acquisition, but you're having a deferred tax expense already in the consolidated P&L. That does not make sense, right? It's relating to acquisition of the entity. So therefore it will go to goodwill. It will not be adjusted in the profit and loss. It will not be adjusted as a deferred tax expense. Goodwill is the asset. So we are adjusting it in the goodwill. We are adjusting it in the goodwill. All right. So that takes care of your query. All right. Now we move on. So now, nature of the above transaction in a business combination with limited exceptions, identifiable assets and liabilities are fair valued, but the tax base of the identifiable assets and liabilities are not affected. Yes. So what am I going to do? I will recognize a DTA, DTL, which I did just now in the question. This affects goodwill or bargain purchase gain. That also we saw. See, in this question that I have just now done, if I did not recognize this, my goodwill would actually have been how much? My goodwill would have been 430. But because I have recognized a deferred tax implication on business combination, my goodwill actually became 490. My goodwill became 490. So goodwill or bargain purchase starts to get affected. If the transaction affects either accounting profit or taxable profit, where am I going to recognize? You will recognize it in the profit or loss. Okay. Transaction not falling in A or B above. Transaction not falling in A or B above. Example, purchase of asset or receipt of government grants. You will not recognize a deferred tax asset or a deferred tax liability. Why? See, suppose I have acquired an asset. This asset is never going to be depreciated for tax purposes. This asset, even when I sell it, the gain or loss will never be affected. Okay. In fact, if you remember or if you have gone through the income tax laws, we do have this case where suppose I am having where we have the definition of capital asset. And in the definition of capital asset, I think it is section 2, subsection 42 or something like that. So in the asset, in the definition of capital asset, correct me if I'm wrong, it excludes personal effects. It excludes personal effects. And personal effects could mean certain capital assets which otherwise are assets. But otherwise, we will not be taking them in the definition of capital assets. For example, a salaried employee purchases a car. In the ordinary case, it becomes a capital asset. It becomes a capital asset in common parlance. But for the purposes of income tax, neither are you going to get depreciation allowance on that, nor are you going to get fuel allowance on the car that you have purchased. So basically, it becomes an item of personal effect. And tomorrow, when you exchange this car for a new one, the gains or losses that you are going to arise in respect of the sale of this car or exchange of this car, that gain or loss will not be taxed in your hands. So that is a capital asset, which is a personal effect and hence excluded from the scope of income tax capital asset definition. So those are the cases which we are talking about in point C. Those are the cases which we are talking about in point C. A transaction not falling in business combination or a transaction which does not affect my accounting profit or the taxable profit. So that is a case where deferred tax asset or deferred tax liability is not recognized, because for tax purposes there is no movement that will happen in the value of that asset. कोई movement नहीं है. There is no movement that will happen, and therefore I will not recognize a DTL or a DTA. Okay. And even subsequent changes such as depreciation of that asset will not be recognized. For accounting purposes, I have to depreciate, but tax purposes, uska depreciation bhi aapko nahi milne wala hai. And that is why you are not going to recognize that particular deferred tax component. Okay. So for example, you have Entity A acquires a foreign made vehicle directly from the vehicle manufacturer, and the transaction is not a part of any business combination. The tax laws do not permit any depreciation thereon. Also, the profits at the time of sale are not taxable, neither are the losses tax deductible. Assume the tax rate to be 30%. Ideally, I should be recognizing a deferred tax liability. Ideally, yes. Why? I have a carrying amount, I have a tax base. For carrying amount, I will record the asset, I will start to depreciate it, so on and so forth. But for tax purposes, this is not going to be recognized. This is not going to be recognized. Okay. So therefore, whether a DTA or a DTL can be recognized in this case, neither. Both you cannot recognize because it is not having any tax implication. Tax laws do not permit any depreciation. Profits at the time of sale are not tax deductible. तो कभी recovery होगा ही नहीं. The recovery of this, if it is a deferred tax asset, or the future payment, if it is a DTL, will never happen. And therefore, will I recognize a DTA or a DTL? Answer is no. I will not recognize a DTA or a DTL. Okay. All right. Entity X acquired an intangible asset, a license of 10 crores with a life of 5 years. Asset will be solely recovered through use. मतलब उसको बेचेंगे नहीं. I'll not sell that. No tax deductions can be claimed as the license is amortized or as and when the license expires. No tax deductions available on disposal. Trading profits will be taxed at 30% from the use of this license, whether you can recognize a DTA or a DTL. Whether you can recognize a DTA or a DTL. Yes. Will you recognize? No, this asset has no implication whatsoever. This has no implication whatsoever. And therefore, will I recognize the deferred tax? Answer is no. Will I recognize the deferred tax at the time of disposal? Answer is no. Will I recognize the deferred tax when I start depreciating my asset for accounting purposes? Again, the answer to that is no. हम कभी भी ये amount recognize नहीं करेंगे. We will not recognize the deferred tax on this because it is not having any tax implication. Because it is not having any tax implication. All right. Fine. So similar question is there in the additional question section. Similar discussions are there. Okay. Does not recognize the resulting deferred tax liability. Carrying amount falls to 800. In earning the taxable income, entity will pay tax of 320. Does not recognize the deferred tax liability. Same question it is. Same question. Only thing is we have taken the case with certain numbers. Okay. Same case, question number 7, extra question. We are not going to recognize the related deferred tax asset. We are not going to recognize the related deferred tax asset. Okay. Is it fine? Is it okay? Yes. Next. An entity set up a factory in a backward area. An entity has set up a factory in a backward area against which it received a government grant of 10 lakhs. The grant amount is set off against the property as per Ind AS 20 and shown at 40 lakhs. Have you done Ind AS 20? Have you done Ind AS 20? Answer is yes, I think so. Okay. So Ind AS 20, you have received a capital grant. That grant you are adjusting against the cost of the property, plant, equipment. So therefore it will appear at a net amount of 40. For tax purposes, the same is not deducted. The relating tax base is 50 lakhs. Can the related DTA be recognized? Okay. So this is the first explanation, what has happened. This is the second explanation. Due to carrying amount less than tax base, it is resulting in a deductible difference. However, since it does not affect accounting or taxable profit on initial recognition, and it is not a business combination, related DTA is not recognized. And even when depreciation in respect of the asset is charged to P&L, DTL will not be recognized, as it would be pursuant to the initial recognition. Okay. All right. I'm coming to reassessments. It will be the next part of discussion, maybe seventh or eighth step. Okay, Viraj. So just give me some time. Okay. So we have done these three questions. Okay, we have done these three questions. There is no tax impact. There is no tax impact. Because of this asset or liability, you are not having any tax impact. So therefore, no deferred tax implications. Okay. All right. So now coming to Ind AS 32, financial instruments presentation. See, typically, you are having certain compound financial instruments. And because you are having certain compound financial instruments, like a convertible debenture, for example, what do I do is I record the asset, the liability, partly in equity and partly in the liability. But for tax purposes, tax department को बोलो we are following Ind AS 32, Ind AS 109, वो बोलेगा तो मेरे को क्या फर्क पड़ता है? You got a loan of 20 lakhs, अब चाहे convert करो, कुछ भी करो, I am not going to be concerned about that. How you do the accounting is your problem, but it gives rise to a deferred tax impact. It gives rise to a deferred tax impact. Why? Because I'm splitting the bond into a liability component and an equity component. Okay. And secondly, these differences are not eliminated so easily. The liability component is going to suffer the effective interest rate component. Yaad karo amortization table. Equity component will go and sit in the equity. The liability component, I will every year charge my effective interest rate. Whereas for tax purposes, वो तो वही bond है, it is the same bond, and because it is the same bond, you are going to recognize the coupon rate of interest for income tax purposes. Whereas in the Ind AS 32-109 principles, what am I going to do? I am going to record the effective interest rate as my expense. Whatever payment I make as per coupon rate will be taken just as a payment and not as an expense. So every year I am going to have this particular difference. Every year I am going to have this particular difference. So how am I going to recognize? Where am I going to recognize? Let us understand this with the help of this extra question. Please remember, please note, this question is not there either in the study mat, neither is it there in the RTP, nor I think it has been asked in the examinations. Okay. But it is just put in here for you so that you get an understanding of how the accounting is going to happen. Okay. We can see it's a very beautiful question. Okay. Please pay attention to this. It's very interesting, and it will solve all our difficulties which are there. Slater Limited issues 1,000 convertible bonds on 1st April 20X1 at par. Each bond is redeemable in 3 years' time at its par value of rupees 2,000 per bond. So redemption happens at par. So the value of the bond issue is 20 lakhs, 2,000 into 1,000. Alternatively, each bond can be converted at the maturity date into 125 1 rupee shares. The bond pays interest annually in arrears at an interest rate based on nominal value of 6%. This is your coupon rate. The prevailing market interest rate for 3-year bonds having no right of conversion is 9%. So required, show the presentation of the compound financial instrument in the financial statements at inception. The 3-year discounting factors are given below. Discounting factor at 6%, you are given simple as well as you are given cumulative. And also discuss the deferred tax implications if for tax purposes the convertible loan has to be recognized at the face value of 20 lakhs. Okay, so it's a question you are familiar. So tax base of the bond is 20 lakhs. No difficulty, no doubt about this. Coming to Ind AS 32, we will have to split it between the debt and equity component. Are you with me? By using the discount factor as applicable to the prevailing market interest rate, which in this case is 9%. So value of the bond is regarded as the PV of the outflows of the bond using the interest rate of 9%. The working is as under. Okay, the working is as under. So now you know this better than me, but I'm still running you through that. At the end of maturity, you are going to pay the 20 lakhs. So 20 lakhs into 0.772. So this is going to give me 15,44,367. Interest is going to be paid annually. So 20 lakh into 6%. And this will be based on the 9% annuity factor. So that comes to 3,03,755. So total debt component is having a valuation of 18,48,122. That means in your liability, you will be recognizing 18,48,122. The equity component of the bond is a balancing figure. So 20 lakhs minus 18,48,000. That is going to give you your equity component, 151,878. Are you okay with this? Are you fine with this? Or is there any doubt here? Is there any doubt here? Up till now, is it clear? Yes? Bolo. Everyone? Yes. टैक्स रेट कहीं पे दिया है क्या अपने को? नो. Tax rate is 30%. Tax rate is 30%. Okay. So now let us look at the bond amortization schedule. Let us look at the bond amortization schedule. This is what you have done always. Just look at the carrying amount part first. Opening 18,48,000 plus interest at 9%, paid at 6% gives you the closing 18,94,453. That is the opening for the second year, and at the end of the third year, the closing comes to 20 lakhs. So this is what we have done. This is what we have done. Okay. Now look at the deferred tax component. See, I am recognizing my tax base is 20 lakhs. So here there is no doubt. My tax base is 20 lakhs. Now 18,48,000 minus 20 lakhs. Opening difference is 1,51,878. This is the amount which has gone in equity, but right now I'm not talking about the equity component. Right now I'm talking about the difference. Okay. So now what is happening is my carrying amount of the liability. my carrying amount of the liability is less than the tax base. Carrying amount kitna tha? 18,48,000. Tax base is how much? 20 lakhs. So carrying amount is less than the tax base. That means a direct relationship. So underlying is a bond. So I should be ideally creating a deferred tax liability. I should be ideally creating a deferred tax liability. And moreover, not only the deferred tax liability, so this will become a taxable temporary difference. This will become a taxable temporary difference. So what am I going to do? This taxable temporary difference is 1,51,000. On that, you multiply with the rate of 30%. So your opening deferred tax liability comes to 45,563. Opening DTL comes to 45,563. Closing is 18,94,000 versus 20 lakhs. So this is 1,05,000, 31,664. So your DTL reversal, you will deduct opening minus closing to arrive at a DTL reversal. So this is your DTL reversal. All right. The same thing continues for year 2 and year 3. Is this part okay till now? The deferred tax component working, is it okay till now? Yes, Bolo, is this understood? So far, did you understand the deferred tax component? Yes. Okay, please explain again. All right. See, look at this figure. 18,48,000. Okay. Opening. Carrying amount, tax base. See, my opening carrying amount was 18,48,122. Sir, ye kahan se aa gaya? This has come from this working. You have understood this working. Okay, so 18,48,122. So 18,48,122. What is my tax base? Sir, my tax base is 20 lakhs. The tax department ko farak nahi padta. It does not matter whether you follow Ind AS 32 or you follow ICAP. Tax department will say, bhai, mere liye the liability is 20 lakhs. Whatever you do is your lookout. I am not going to fall into that. So is this a temporary difference? Definitely. It will reverse. So what is the difference? 18,48,000 minus 20 lakhs. So 151,878 multiplied by 30%. This gives you 45,563. Carrying amount is lower than the tax base. Carrying amount is lower than the tax base. So what I'm going to recognize is a deferred tax liability. Is a deferred tax liability. Where do I recognize all of that? We will see it later. All of that we will see it later. But as of now, this is the opening balance DTL. Okay. Closing. What will happen? See. I have 18,48,122. To this, I am going to recognize the effective rate of interest of 9%. So 1,66,331. So that gives you how much? 18,48,122 plus 166,331. So this gives you 20,14,453. But sir, you are paying something? Yes, I am paying the coupon rate. I am paying the coupon rate. So that is 1,20,000. So minus 1,20,000. So end of year 1, This is 1894 453. But what is the TB balance end of year 1? Same, 20 lakhs. So what is your temporary difference now? Well, it is 1,05,547 into 30%. So this is 31,664 DTL. You had an opening DTL of 45,563. End of year 1, that DTL has fallen to 31,664. So can I say that reversal of DTL is nothing but 45,563, 31,664. So how much does that come to? That comes to 13,899. Have you understood now? Yes. Have you understood now? For tax purposes, the amount does not change only. 20 lakhs remains at 20 lakhs. 20 lakhs remains at 20 lakhs. Yes. All right. So this is year 1. Same thing will happen in year 2. End of year 1, this becomes the opening balance for year 2. Closing is 19 lakh 44. You will compare it with 20 lakhs. So DTL taxable temporary difference on the closing is 55,046. The DTL reversal is 15,150, and this one 20 lakhs. Ultimately, the closing difference is 0. Closing DTL also becomes 0. Yes, Kaushiki, clear? Soham, did you follow the bond amortization schedule as well as deferred tax? Viraj, did you follow? Manini confirmed, Kaushiki confirmed. Sanjay, did you follow? Shailendra Samja? Yes, did you guys follow? Yes, okay. So the DTL which I created initially, that is getting reversed. That is getting reversed. Dekho, 45,000 was what I had created first. End of the bond period, it is reducing to 0. End of the bond period, it's reducing to 0. Okay. So now let us proceed to do the calculations or the journal entries. Sorry. First entry, when you get the proceeds, entry will be bank account debit to equity to liability, to equity to liability. So this is the entry that you are going to pass. Okay. Now I have to recognize a deferred tax liability. Okay. So credit will be deferred tax liability 45,563. Where will the debit go? Sir, the debit should go to the place where the difference has actually been recorded. If it were to be in the P&L, it would go to the P&L. If it were to be in the OCI, it will be in the OCI. If it were to be in statement of changes in equity, it will go to statement of changes in equity. So this is treated as an equity item. So therefore, where is it going to go? It will go straight away to equity. It will go straight away to equity. 45,563. Have you understood the second journal entry? Have you understood the second journal entry? Have you understood the second journal entry, everyone? Yes. Okay. Dekho. This is my temporary difference. This is my temporary difference, 1,51,878. Sir, why are you saying it is temporary? Array, opening difference was 151. closing is becoming 0, no? So it becomes a temporary difference. Where am I recording this temporary difference? Sir, I am recording it in equity. I am recording it in equity. How am I recognizing this equity? How am I recognizing? Based on the Ind AS principles. Sir, so where will I recognize the deferred tax? I took you through it in the very first session. Transactions and other events of the current period. Events recognized outside the P&L. Where am I going to recognize? Related tax effects goes in OCI. If the impact had gone in OCI. If the impact has gone in equity, the related tax impacts go in equity. If the events and transactions are in P&L, the related tax impacts also will be recognized in P&L. So in this instant case, that 1,51,000, where did it go? Sir, it went in statement of changes in equity, means equity mein. So where am I going to recognize the debit or credit relating to DTL or DTA? I will be recognizing it in the statement of changes in equity. That means basically my equity. That means basically my equity. Are you clear with this? Yes. Are you clear with this? Everyone? Yes. So therefore, since 1,51,878 difference has gone in equity, the deferred tax liability is also recorded in equity. The deferred tax liability is also going to go and sit as a part of your equity. Is it okay? Yes, all clear? We are coming to the P&L part, Soham. Just wait for it. Just wait for it. Okay. The creation of this difference has gone in equity. So the creation of deferred tax liability went in the equity. Okay. हम तो अभी creation पे ही अटके हुए. We are still stuck in the creation. The reversal we are going to come to it. The reversal we are going to come to it. Okay. Now coming to the transactions for the year. ये तो दोनों हो गए. I hope you have downloaded these sheets, by the by. These are very important sheets. Okay, so this is opening, or what we call as initial recognitions. Okay, this is the initial recognition. All right. Now let us move on to the next part. Let us move on to the next part. End of the year, I am going to book my expense. So interest expense will be recorded where it will be going to the P&L. Interest expense to the P&L. This is based on effective interest rate. This is based on effective interest rate. So 1,66,331. That means it is this figure. 1,66,331. Okay. All right. Then what am I going to do? I will be paying it. I will be paying the coupon rate. So therefore, liability to bank, repayment at 6% coupon as per the amortization schedule. Yeah, this is interest expense just transferred to the P&L. Just transferred to the P&L. That's it. So till now, are these entries clear? Till now, are these entries clear? Yes. Are these entries clear till now? Yes or no? Bolo. Yes. All right, fine. So now the next part. See, by virtue of Ind AS 32, there is a reversal there is a reversal of the deferred tax liability that was recognized initially on opening. Sir, why this arises? This arises because of effective interest rate. The interest expense is based on effective interest rate, whereas the payment is made through the bank based on the coupon rate. So there is going to be a reversal of the deferred tax, which I have recognized. The deferred tax reversal is happening because of the interest which is recognized on the basis of the effective interest rate. The interest recognized on the basis of the interest that has been based on the effective interest rate, that interest was recorded in the profit and loss. This 1,66,000 has gone in the profit and loss. It is because of this 1,66,000 that we are now seeing a reversal in fortunes. My deferred tax liability is reducing because slowly the carrying amount of the liability starts to increase. And because the carrying amount of the liability starts to increase, what am I having? I am having initial carrying amount 18,48,000. I am having initial tax base of 20 lakhs. Now 18,48,000 has increased to 18,94,000. This increase means that my deferred tax liability has come down. Yes, it has come down. But where am I going to reverse this 13,899? How am I going to reverse this 13,899? Sir, this 13,899, we will be reversing it through the profit and loss account. Why am I reversing through the P&L? Because the reversal is happening through the P&L. How is it happening through the P&L? By applying effective interest rate on the opening balance. By applying effective interest rate on the opening balance. So this reversal is going to take place through the P&L. Sir, but creation hua tha equity mein. Creation happened in equity because the gap went into the equity as per Ind AS 32. Now wahi gap is reducing on account of entries through the profit and loss account based on the effective interest rate. So the reversal of deferred tax is going to happen through the P&L and not through the equity. Sir, equity amount will remain the same there, but the liability amount will ultimately unwind and reach 20 lakh rupees. Is it okay? Yes. Have you understood? Have you understood? Yes. All clear, everyone? Is this explanation clear? Bolo yaar. Yes. Viraj, Shailendra, Manini, Kaushiki. Soham, got it. All right. Uske baad kya hai? After that, तो we are all experts, right? The only problem with CA students, even I was one once upon a time, we only have a starting problem. Once the starting problem is sorted out, we can easily take off with the remaining. So year 2 ke case mein, same entry is going to be passed. Only thing is amounts changed. Only thing is amounts changed. Okay. Video is coming and going. Okay. So it looks like a Mr. India is there in front of you who is taking the class. Never mind. Okay. So interest expenses 1,70,000. That is gone to the P&L. Liability is paid. Deferred tax reversal is going through the P&L. Year 3 also the same thing. Year 3 also the same thing. Okay. At the end of the year 3, your deferred tax liability is fully reversed. Okay. At the end of 3rd year, DTL is fully reversed and becomes nil. DTL is reversed to the P&L because the interest on the bond is debited to the P&L. Okay. The the reversal is happening in the P&L because the debit is happening in the P&L, and accordingly reversal is credited to the P&L. And yaad karo, if you have studied Ind AS 32-109, you would remember that sir would have told you that the amount sitting in the equity will permanently remain in equity. So 1,51,878, this amount which I have recognized initially in the equity, company ke marte dam tak this amount will remain there only, and only this amount will remain there. What is being reversed is not going to remain there. What will be reversed in respect of the interest and the liability component, the deferred tax on that cannot remain there. The deferred tax also has to get reversed and turn to zero. So that reversal goes through the profit and loss. That reversal goes through the profit and loss. Have you understood this question? Yes, have you understood this question? Even if one of you has a doubt, I can take you through it again. 45,563 would be deducted from the equity. Yes, 1,51,000 minus 45,563. Yes, that will also go from the equity. Yes. Kaushiki, Viraj, Soham, Manini, Shailendra. Sumit Jain is not there today. Aaj Sumit Jain nahi hai. Yes. Soham, is it okay? Soham, उसने बताया था clear. Yes. Okay. All right. Fine. So now let us read the note. In accordance with Ind AS 32, the issuer of a compound financial instrument classifies the liability component as a liability and the equity component as equity. We have done that. The deferred tax is charged directly to the carrying amount of the equity component. We have done that. 45,563, when I recognized, I have passed the entry as equity account debit to deferred tax liability. 45,563. In some jurisdictions, the tax base of the liability component on initial recognition is equal to the initial carrying amount of the sum of the liability and equity component. Sir, iska matlab kya hua? What is the meaning of this? Tax base was how much? 20 lakhs. What is 20 lakhs? 151,877 plus 1848,122. What is this? This is the equity component and this is the liability component. So what they are saying is, in some jurisdictions, the tax base of the liability component is equal to the initial carrying amount of the equity plus the liability component, which in our case was 20 lakhs, which in our case was 20 lakhs. The resulting temporary difference arises from the initial recognition of equity component separately from the liability component. Initial difference tha na bhai, 20 lakh मैंने recognize किया versus 18,48,122. Initial difference क्यों था? Why did I have the temporary difference? Because of the equity component. So what am I doing now? The deferred tax is charged directly to the carrying amount of the equity component. And thereafter, in accordance with para 58, subsequent changes in the DTL are recognized in the P&L as a deferred tax expense or income. Because it is a reversal, it would amount to an income. Are you okay with this explanation in totality? Yes. Are you okay with this explanation? We have done it as per the standard. We have done this as per the standard. Okay. So this question, go through it. It's a very important question, and that is going to help you understand the temporary differences on initial recognition as far as the financial instrument chapter is concerned. Okay. So that takes care of this. Coming to the next part. Investment in subsidiaries, branches, and associates, as well as interests in joint arrangements. Okay. Now, why am I going to have this issue? What are the issues which I can see? What are the issues which I can foresee? There could be undistributed profits. There could be forex rate changes. There could be reductions in the recoverable amounts. There could be recoverable amounts. Okay. All right. Because of this, you are going to have either a DTL or a DTA. Don't think that reduction to recoverable amount is DTA, existence of undistributed profits is DTL. ऐसे मत सोचो. These could be the impacts. These impacts could either give rise to a DTL or it could give rise to a DTA. All right. You will be recognizing the DTL in all cases. See, except for, look at the words very carefully. Okay. You will be recognizing the DTL except for, means the general requirement is DTL should be always recognized. Whereas in the case of DTA, only when, that means generally you will not recognize a DTA, but only in these two cases you will recognize. Okay. So why that is the case, we will just look at it maybe towards the end of today's session. But as of now, this is the impact. Okay. So you can recognize a DTL except for control over the timing or the non-reversal is probable. If that is the case, do not recognize a DTL. Recognize a DTA only when reversal of the DTA is possible and taxable profit is available. Taxable profit is available. Okay. So we shall look at why this particular exception arises. Why this particular exception arises. Okay. See, one thing is DTL, deferred tax liability, starts to hit the P&L generally. Okay, generally it starts to hit the P&L. Because of this, what happens is companies may be reluctant to pass a DTL entry. Companies may be reluctant to pass the DTL entry because it brings down their profits. It brings down their profits means it starts impacting the distributability of the profits. It starts impacting the dividend distribution ability of my profits because मेरा P&L impact कम हो गया. At the same time, entities are very happy to pass a DTA entry. Entities are very happy to pass a DTA because it increases the profit after tax. That means you can increase the dividends. So this is the common thing that each and every company will be having. This is the common feature. Okay. DTL, they will be reluctant. DTA, they will be more than willing. So therefore, the standard has put up, has plugged this loophole by saying that if you are able to control the outflows, only then DTL will not be recognized. Otherwise, DTL has to be recognized. And for the DTA, it has put in only two cases where you can recognize the DTA. Both the conditions which are there, both the conditions for the DTL as well as the DTA, those conditions are based on pure conservatism principle. They are based on conservatism principle. Okay. So now let us look at it. See, parent controls the dividend policy of its subsidiary. Obviously, it's a majority stakeholder. It will control. So therefore, it is able to control the timing of the reversal of temporary differences. It can control that. And that is why it would often be impracticable to determine the amount of income tax that would be payable when the temporary difference reverses. So if the parent has determined that those profits will not be distributed, there is no need to recognize a DTL. Okay. So this is just theoretical. You can go through it. It's not a big deal. Okay. All right. Non-monetary assets and liabilities are measured in the functional currency under Ind AS 21. If the entity's taxable profit is determined in a different currency, changes in exchange rate gives rise to temporary differences. याद करो, FCTR बनाते थे हम. We used to recognize an FCTR. Okay. Changes in the exchange rate give rise to temporary differences. Resulting deferred tax is charged or credited to the P&L. Resulting. Okay. An investor in an associate does not control. So therefore, DTL arising from taxable temporary difference continues to be recognized. Subsidiary ke case mein, if you are controlling the outflows, do not recognize. Associate ke case mein, you always you will never control, so therefore you will have to recognize. And non-monetary items, changes in exchange rate gives rise to temporary difference, take that to the P&L. Okay, so that is there. Next, you can go through this. It's the same thing what I'm discussing right now. Okay, so with this background, let us come to certain questions. Okay, today I'm feeling I have taught quite a bit in, but when I look at the time, it's just 1.5 hours that has passed. Okay. All right, fine. So now let us look at question 2. Okay, on 1st April, ABC Limited acquired 100% shares for 4,373 crores. By 31st March 20x5, XYZ had made profits of 5 crores, which remain undistributed. Based on the tax legislation, the tax base of the investment in XYZ Limited is its original cost. Assume the dividend distribution tax rate applicable is 15%. Okay. So now the question is, will I recognize, show the deferred tax treatment? Show deferred tax treatment. Okay. So now see, carrying amount is going to be 4,378. Sir, kaise? अरे होगा ना 4,378. You paid 4,373 and the profits of 5 crores are also going to be added to you. Sir, undistributed है तो क्या हुआ? You are controlling the subsidiary. Means कायदे से your investment is worth 4,373 plus the 5 crore on that. So therefore it is worth 4,378. Coming to the tax base, this tax base remains as 4,373. The tax base remains as 4,373. So clearly carrying amount is greater than the tax base of an investment. And because the carrying amount is greater than tax base of the investment, ideally I should recognize a deferred tax liability. 5 crores into whatever is the tax rate. This should be the DTL that I should recognize on this particular item. But wait a minute, you will have to check whether you are the parent or whether you are the whether you are parent having a control or whether you are an investor having no control. So now here I am the parent. How do I know? 100% stake. That means you are having control. That means what? Can I control the distributability of this 5 crores? Answer is yes, you can. And because you can control the distributability of this 5 crores, will you provide the DTL? Answer is no. Unless you have no intention to distribute the 5 crores, you will not recognize this DTL. Who is having the authority over these 5 crores distribution? Sir, it is the parent who is having the authority. So parent will have in its mind whether it intends to distribute or not. And because of that purpose, will I recognize the DTL? Answer is no, it's not needed, because in this case, ABC Limited has the power over the dividend policy of XYZ Limited. And that is why there is not going to be any DTL impact on account of this temporary difference of 5 crore. Is it okay? Have you understood? Have you understood? So conversely, on a similar case, ABC acquired 50% of the shares on 1st January. By 31st March 20x5, PQR had made profits of 50 crore, that is ABC Limited share, which remained undistributed. So what is the value of the investment? 1000 plus 50. 1050 crore. This is my carrying amount. What is your tax base? Tax base is 1000. Because the tax base is 1000, this is giving rise to a difference of 50. Sir, what do I do with this 50? Is it deductible or taxable? Carrying amount is greater than the tax base of an investment, so it becomes a taxable temporary difference, which ideally should give rise to a deferred tax liability. So 50 into 15%, this comes to 7.5, if I'm not wrong. 7.5. Ideally, a DTL should be recognized. Ideally, a DTL should be recognized. But wait a minute. Am I controlling the dividend distribution of PQR Limited? Answer is kahan. You are owning only 50% shares. That means somebody else may be there whose ownership pattern I do not know. But it is possible that I am not in a single, I am not singly able to control the dividend distributability. And because I am not able to control, do I have to recognize the DTL? Answer is yes. Recognizing the DTL becomes mandatory in this case, because ABC is not in a position to influence the distributability of dividends of PQR Limited. Of PQR Limited. Is it okay? Yes. Have you understood? Did you understand? Yes. All clear, everyone? Manini, question number 3 is clear. Both the questions are clear. Kaushiki, is it clear? Shailendra, Viraj, Sumit Jain, if you are around. Soham, all clear? Okay, fine. If ABC has 60%, you are controlling. So do not create a DTL. Okay, do not create a DTL. Okay. So importance is control. If you are controlling, then go ahead, do the DTL, do not do the DTL calculations. Okay. So that takes care of these 2 questions. Okay. Coming to the next step, step number 6. Okay. All right. See, DTA. See, the logic being, see what I told you. If I have to recognize a DTL, I will take a charge to the profits. I will take the charge to the profits. Entity will not be willing to pass this entry. Entity will not be willing to pass this entry because it will reduce the distribution of their dividends. Okay. So ABC Limited will not want to pass this entry. Now let us understand. First case. Carrying amount of the investment is 4,378, which is basically 4,375 plus undistributed dividends. Undistributed dividends. carrying amount as tax base is 4,373. So the difference of 5 is because of undistributed dividends. Undistributed dividends, okay, which is lying with XYZ Limited in the first case, PQR in the second case. Now, these 5 crores, see, when I say temporary difference, that means in the future, there is going to be a reversal of this difference. Yes or no? When I say temporary, this difference is going to be reversed in the future at some point of time. Yes. Sir, it is going to be reversed how? Only one way it will be reversed. That is if XYZ Limited pays the dividend to ABC Limited. If XYZ pays the dividend to ABC. If XYZ pays the dividend to ABC, will the reversal happen? Yes, ho jayega. Because then 4378 mein se 5 rupees will be distributed. So therefore it comes to 4373. Reversal ho jayega. But what if the dividends are never distributed? Sir, if dividends are never distributed, this difference will not be a temporary difference. It will be a permanent difference. It will be an other than temporary difference. It will be an other than temporary difference. That means it will never match in the future. Gratuity payment, disallowed on accrual, allowed on payment. Depreciation, higher rate in income tax, lower rate in Companies Act, but in the future, the carrying amount will be written to 0. In the third case, you could be taking a leave encashment, for example. Yes, you could be taking interest, for example. Today it is disallowed because you have not paid. Tomorrow it will be allowed when you have paid. So all these examples, at some point of time, the temporary differences get mitigated and they converge at a particular point of time. But in this case, is it possible that this 5 crores never converges? Yes, it is possible. How, when it is possible? When ABC decides that these undistributed dividends of XYZ हम कभी distribute नहीं करेंगे. Is ABC in a position to do so? Yes, it is in a position because ABC is everything of XYZ. Yes, माँ बाप दादा दादी नाना नानी सब कुछ ABC Limited है. So everything ABC Limited will decide. So if ABC Limited decides that 5 crore will never be distributed, then this difference will never converge at any point of time in the future. And if this difference will never converge at any point of time, then it is not a temporary difference. There is no need to recognize a DTL. In the second case, I have only a 50% stake. So mere haath mein power as such is not there. So therefore, you will have to recognize a deferred tax liability. You will have to recognize a DTL in question 3. In question 2, there is no need to recognize. Okay. So that takes care of exceptions. Then the most important part is deductible temporary differences, tax losses and tax credits. See, as I told you, every entity will be very willing to pass the entry DTA account debit to P&L. Why? Because this particular entry is increasing the profits. This particular entry is increasing the profits. Okay. So whenever they see DTA, you will find that the accounts manager and the director start jumping up from their seats because the dividend distributable profits start to increase. But there is a problem with deferred tax assets. What is the problem? See, DTA. In the name only you see deferred tax assets. Deferred tax assets means assets which arise in future. Assets which arise in future. And yaad karo the definition of the concept of conservatism. What did you study in conservatism? I will recognize all expenses and liabilities even if they are likely to happen. That means there is no need of complete certainty. A probability that they will be incurring, then we are going to recognize the liability. But deferred tax, but assets can be recognized only when they are virtually certain, only when they are virtually certain that they are going to meet the that the assets are going to be realized. So if I have to put a probability scale, if the probability of a liability is more than 50%, recognize the liability, because there is a chance you may end up paying it. So as per conservatism, recognize the liability. Asset के case में वैसा नहीं होता है. In the case of an asset, only when it is virtually certain, you will recognize the asset. What do you mean by virtually certain? More than 95% probability that the asset is going to be recognized. More than 95% probability that the asset is going to be recognized. So when that is the case, look at the huge amount of certainty that we expect from an asset. So now coming back. So what is the problem with deferred tax asset? This asset is arising in the future. So I need to be very sure. I need to be very sure that this asset is definitely going to arise in the future. I need to be very, very sure of that. How can I be sure when it is talking about the future? यार मेरे को तो अभी से मतलब है. I am not sure about what will happen in the future. That is why the standard tells you will have to assess and reassess deductible temporary differences, tax losses and tax credits. See, why am I going to have a deferred tax asset? Why am I going to have a deferred tax asset? For example, you are going to, so suppose take the case of gratuity. Take the case of gratuity. Okay. Now the gratuity, the gratuity part which is there, in the P&L, you debit it based on your actuarial calculations. So you will debit and reduce the profit. But for tax purposes, will you take the gratuity based on the actuarial values? Answer is no. It will be added back, because gratuity is deductible only on a payment basis. If government had to allow gratuity on accrual basis, log dhadadhad karke accrue karenge and they would have reduced their tax liability. So that is why government said you pay the gratuity, we will allow. So what is happening is, today I recognize a gratuity expense. On that gratuity expense, I'm not going to get a deduction. So therefore, I will add it back in my computation. So when I add it back, essentially today I'm paying a higher tax in the hope that in the future lower tax will be paid, because gratuity will be allowed as an expense. So today I'm having a deferred tax asset because of this gratuity. I'm having a deferred tax asset because of this gratuity. In the future, I will pay this gratuity. Yes. But what I want to utilize this asset is, in the future, do I have deductible temporary differences? Do I have adequate taxable profit? Suppose my gratuity amount is 100 crore today. In the future, I should at least have a taxable profit of 100 crore. Only then my deferred tax asset which I am creating today can be utilized in the future. चाहिए क्या अपने को? whatever is the deductible temporary difference I am recognizing today, I should ensure at least that much of taxable profit is available in the future, because against that taxable profit, the deductible temporary difference will be deducted in the future. If I am not sure about the existence of taxable profit in the future, you cannot recognize a deferred tax asset. You cannot recognize. Okay. So therefore, if you have deductible temporary differences, you must have certainty that taxable profit will arise in the future. Taxable profit will arise in the future. And if that is the case, only then in such circumstances you can recognize a deferred tax asset. That means I'm talking about this part. DTD, deductible temporary differences, can be recognized if and only if there is a certainty of existence of taxable profits in the future. If that is the case, then whatever are the deductible temporary differences arising today, you can recognize a deferred tax asset on that. Agar nahi hai certainty, then don't recognize a deferred tax asset. Then don't recognize a deferred tax asset. Okay. So ye to ho gaya baat deductible temporary differences. Acha. Suppose we have a business loss. Suppose we have business loss. See, if I have income, I pay the tax. If I have a business loss, government does not give me refund of income tax. What government tells? Carry forward the losses. Carry forward the losses. In the future, when you earn the profits, you can set off these losses. So there is a history of recent losses, or there is a carry forward of unused tax loss or credit. So what happens is, you should have a strong evidence of taxable profit arising in the future, which can meet this tax loss, As far as I remember, carry forward of losses, business losses, is allowed for a period of 8 years. That means you should be in a position to say that within the next 8 years, I am going to have a taxable profit. If you are unable to show that, particularly like cases where infrastructure projects with long gestation periods, with long with long periods of losses. Take for example all these startups which are there. Take any startup. Take a startup like Cred. Take a startup like Flipkart. Take a startup like any startup you take. These startups have huge amount of unused tax losses, huge amounts. The question is, take a startup like Paytm. Abhi tak profit mein aaya nahi hai. If you look at Paytm's valuations, they started to create a new KPI. They are now saying we will not report EBITDA, we will be reporting adjusted EBITDA. Why am I reporting adjusted EBITDA? Because I am not deducting stock options. Because stock options is not deducted, I am having a positive EBITDA, which is a very stupid argument in my case. ESOPs is an expense which you are going to incur, which forms a major percentage of your expense. So if you are reporting adjusted EBITDA, that is not the fair way to do a reporting of your numbers. Your numbers should be EBITDA based on the accounting concept. These companies run into losses for 8 years, 10 years, 15 years, and they are burning the cash of the capitalists who invest in them. I'm not saying all of them will go into losses. They would be having definite profitable models. But my point is, within the next 8 years, will they earn the profits? Answer is unlikely. So because of that, whatever losses are arising today, can I recognize a deferred tax asset on that? The answer is no. The answer to that is no. Zomato is not in profit. Okay, Zomato is not in profit. Jio is a profitable entity now. Jio is a मोटा भाई को तो पहले से ही पता था कि उसको profit आएगा. It was an addiction that they made first to all the customers by giving by giving free SIM cards, free calling for 1.5 to 2 years. You have to look at the house that runs them. See, Reliance is a huge entity that can bear lakhs and crores of losses. But other entities, I'm not very sure. And Reliance is still a family-owned business. Still a family-owned business. Okay. So therefore, that fellow has deep pockets. So though Jio had a loss in the beginning, by now Jio is in a very profitable situation. Okay. In fact, the earnings from the telecom business of Reliance far surpass the petrochemicals business, is what I understand. Okay. So therefore, Jio is profitable, but companies like Zomato, companies like Paytm, Cred and all, you look at them, to earn 1 rupee, they are spending 261 rupees, 300 rupees. It's crazy out there. All right. So when these are the scenarios, you are unable to predict with certainty that taxable profits will arise. So suppose Cred has reported a 350 crore loss today. Can it recognize a deferred tax asset in that? That is a big question mark, because Cred, if he can show that within the next 10 years, within the next 8 years, if Kunal Shah can show that we are returning to taxable profits, go ahead and recognize deferred tax asset. But अगर आप display नहीं कर पाते, then do not recognize a DTA. Acha, this is a huge judgment call. This is a huge judgment call, because yaar apne ko what happens tomorrow I cannot predict. These startups are all fancy people with beautiful spreadsheets, but whether it will come to reality, nobody knows. Okay. Probably they themselves do not know. Okay. They are basically pitching ideas to the venture capitalists who invest in them. So they have to show certain optimistic numbers. But when you, in case you are going into the assurance field, when you are going to audit these numbers, you require a high degree of professional skepticism by questioning each and every number that they are putting in their forecast. Otherwise, we are going to end up recognizing deferred tax asset today, recognizing income today, and after 8 years, you still note that there is a huge amount of losses which the company is incurring. You will end up with a false reporting today. Okay. So that is why DTA comes with its own caveats. Okay. With its own beware. When you see DTA, red light should start blinking in your head. Okay. Ki DTA kaise aa gaya? Okay. Because even the authorities are very skeptical about DTA. If you read NFRA's audit quality reports, the fundamental question where they have asked many times is, how are deferred tax assets recognized? Does the auditor have a proper documentation of deferred tax assets? Does he have a documentation of whether deductible temporary differences will be available in the future? Does he have the documentation of whether tax profits will be arrived at in the next 8 years? All that data is required for us to understand whether a DTA should be recognized, Okay, so basically that is all about deferred tax assets. You have to be damn sure about, sorry for using that word, but you have to be damn sure that you are returning to profits within the time span given for absorbing the losses. Otherwise, do not recognize. Okay. So now you can go through this question for homework. This is simple one. Okay. I'm leaving this about I am not going to comment on certain things which are sensational right now. Okay. Right now, I will not comment on that because many things are sensational. Okay. So keep quiet. Let us see what the things happen. Okay. So coming to the next part, existence of, okay, so now let us look at these points. Okay, what do you mean by existence of taxable temporary differences? So you will have to check whether I'm having taxable temporary differences in the future. If I'm having taxable temporary differences in the future, then at that point of time, you can adjust the deductible temporary differences against that. Okay. So now coming to this example, as at 31st March, the entity has both taxable and deductible temporary differences with the following reversal pattern. Okay, so year 1, 2 and 3, you are having opening balance of taxable temporary difference. Opening was 10,000. You have recognized taxable income 5,000. Closing is 5,000. Year 2, this 5,000 is opening temporary difference. 3,000 becomes income. 2,000 becomes my closing. 2,000 is opening, 2,000 closing. This is 0. You remember in that question which we did of Slater Limited. Look at this question. We are talking about, because you may end up getting a little confused ki what sir is telling. So we are talking it in these terms. Okay. See, opening deferred tax liability 45. Closing is 31. Opening 31, closing 16. Opening 16, closing 0. So similarly, opening 10, closing 5. That means 5,000 went in taxable income. Opening 5, closing 3. So taxable income 3. So closing is 2. Okay. All right. I don't know. My camera is on, but the video is not coming. I think there is some loose connection within the camera. I will hope that it comes. I'll have to change the camera probably. Okay. That I don't know why it's happening today. All right. Coming to the deductible temporary differences. Opening is 8. Recognized is 4. Closing is 4. Okay. Opening is 4. Recognized is 3. Closing is 1. Opening is 1. Recognized is 1. Closing is 0. So now the question is, can you recognize the DTA or ascertain what is the DTA that can be recognized for the above? Okay. So what I have to look is, in the future, I am having 4,000 deductible difference, which is getting reversed. 4,000 getting reversed means, think it off like this. If 4,000 gets reversed, that means you are going to get a deduction of 4,000 in the future. Matlab your taxable profit will go down by 4,000. So correspondingly, you will be having a taxable temporary difference. So let us think it of something like this. Okay. Let us think it something like this. This is a deductible temporary difference. This is gratuity. Okay. And taxable temporary difference, this is depreciation. Income tax, you get higher depreciation, and gratuity is allowed on a payment basis. Okay. So it is a deferred tax asset. So 4,000 in year 1, you are going to pay the gratuity. In year 1, depreciation reversal is happening of 5,000. So what happens is, basically in the next 1 year, because of depreciation, your taxable profit starts to go up. See, today I gave a higher tax depreciation. In the future, I'm not going to give that high depreciation. So therefore, my taxable income will go up by 5,000 because of depreciation. Against that going up of 5,000, my gratuity will be paid of 4,000. I still have a taxable income of 1,000. Yes or no? That means my reversal pattern of the taxable temporary difference in the future, is it matching the reversal pattern of deductible temporary difference? Yes. As far as first year is concerned, yes. So in the first year, my depreciation reversal is high, my gratuity reversal is low. Whether I have taxable profit or not, one thing is sure, I can meet the entire deductible temporary difference out of the taxable income difference, out of the taxable temporary difference getting reversed in the next year. So do I recognize the DTA on this 4,000? Answer is yes, you will recognize. First point. Look at the third year. Look at the second year. My payment in the second year is 3,000. Okay. The taxable temporary difference getting reversed is also 3,000. So this is certain, by the way. You know the depreciation pattern. This is also certain, by the way. Okay, this is also certain, by the way. So do I have that? Yes, you do have that. So therefore, can I recognize deductible differences of 3,000? Yes, you can. In the third year, 1,000 is my gratuity which I'm going to pay, and 2,000 is the depreciation that is getting reversed. So can I meet all the deductible temporary differences out of the reversal of taxable temporary differences? Answer is yes, you can. So what is the DTA that you can recognize for the above? Recognize entire DTA. Why can I recognize? Because I have adequate temporary taxable temporary differences which are getting reversed in a similar manner as that of the deductible temporary differences. Okay, coming to the next case. Now in this case, pay attention. 4,000 versus 5,000. Can I recognize entire 4,000? Answer is yes. Go ahead. Can I recognize entire 4,000? Answer is yes. Can I recognize in year 2 4,000 versus 3,000? Answer is no. You are having 4,000 worth of deductible temporary differences, but taxable temporary difference reversal is only 3,000. So therefore, you will restrict it to 3,000. In the third case, you don't have anything to reverse as far as deductible differences are concerned. So therefore, what is the DTA you can recognize? 7,000 multiplied by tax rate. So entire 7,000 deductible temporary differences, only 7,000 deductible differences can be recognized. Is everyone okay with reversal pattern matching? Is everyone okay with reversal patterns matching? Yes. You have to check existence of reversal of taxable temporary differences. You also have to check whether profits are there in the future. So all these things together we will have to check, okay, in practical life. Here we are teaching you step by step, so you should be able to understand. Soham, Viraj, did you follow? Yes. Shailendra, did you follow? Yes. All right. So coming to the next one, check the existence of taxable profits. Check the existence of this is a copy of this or what? 431. Okay, fine. We will look at this. Okay. Probability of future profits. Okay. So now coming back. Okay. All right. So, okay. Soham, is it clear? Yes. All right. Fine. All right. Where 7,000 has come? Aa gaya na? 4,000 year 1, 3,000 year 2, 0 year 3. So 7,000 is the deductible temporary difference. This is not tax. This is not DTA. On DTD, when you apply the tax rate, it becomes DTA. So the DTA that can be recognized is on the entire, is on the 4 plus 3, 7,000 deductible temporary difference multiplied by the tax rate. Ye DTA nahi hai. This is the difference amount. On this, you have to apply the tax rate. Okay. So coming to this case, same as before, only thing what they have given is the entity expects a profit of 750 in year 2. The entity expects a profit of 750 in year 2. So what am I going to do? 4,000 versus 5,000. How much will I recognize? Sir, pura 4,000. Reversal pattern is matching. 4,000 versus 3,000. How much will I recognize? Sir, you will recognize 3,000. But wait a minute, sir. You are also expecting a profit of 750 in year 2. So what is it that I'm going to recognize? 4,000 plus 3,000 plus 750. 7750 is the deductible temporary difference on which you will be recognizing the DTA. So DTD multiplied by the tax rate will give you the DTA that will be recognized. Is it okay? Have you understood, everyone? Yes. So this part is done for you. Yes. All right. I want you to try this for homework. It is based on what we have done. Yes, you should not have any difficulty. They are saying that orders are depressed, etc., etc. वो पढ़ लो. When you are reading only, you will come to know what is the answer. When you are reading only, you will come to know what is the answer. So illustration 1, I leave it with you for homework. Okay. These two examples also I'm leaving you with homework. Okay, simple hai. No doubts should arise on this. Okay. Okay, so you should be in a position to do this. Okay. Okay, this also homework. Sir, kitna homework dete hain? But these are all very simple. Okay, try karo, ho jayega. Okay, see, taxable differences relating to accelerated depreciation expected to reverse equally. So 3,000, 3,000, 3,000, and then 1,000, 1,000, 1,000. Okay, so all this you can go through. Aapko samajh mein aa jayega. You should be in a position to understand it. Try karo. Okay, and then you will also check availability of tax planning opportunities. So what all am I going to look at? First one, if I have to recognize a deductible temporary difference, I will check whether there is a taxable difference whose reversal pattern matches the deductible difference. If yes, go ahead and recognize, number one. Second one, you will check whether the probability of taxable profits is there in the future. If it is there, go ahead and recognize. Third one is you will check whether there is a tax planning opportunity available in the future. For example, you would be aware that for different heads of income tax permits different methods of accounting. Like PGBP, you can recognize based on accrual method, whereas interest you can recognize based on receipt method. Okay, based on receipts. Okay, so suppose you have an income, other source income, which you are recognizing on accrual basis, accrual basis as per the Companies Act. Companies Act, you will always follow it. But for tax purposes, in the future, you decide that if I convert my accrual system into a receipt system, then income will arise in the future. taxable income. That taxable income, I can take it as a step to meet the losses which I am incurring now. Those are known as tax planning opportunities. Okay, so you are having certain sources of income that can arise in the future if you change the method of account, if you change the method of taxing it from say accrual to cash basis. I think कौन सा तो है वो ICDS or something allows it. You can have separate systems for PGBP using accrual, and for other sources you can follow accrual or receipt basis. So in the future, if you change from accrual to receipt, there may be a chance you may end up with a higher income in the future. If that is the case, that higher income may give rise to a taxable profit in the future, and that could meet the losses which you are suffering now. So that is how you are going to recognize it as a tax planning opportunity and recognize the deferred deductible differences today. So you can look at this example. An entity has a deductible temporary difference of rupees 50,000, a deductible temporary difference of rupees 50,000. It has no taxable differences against which it can be offset. There is no future profit also. There is no future profit also. So if that is the case, it can, however, it can implement a tax planning strategy which can generate profits up to 60,000. The cost of implementing this tax planning strategy is 12,000. So in the future, your tax planning strategy will give rise to 60,000 of profits. Again, 60,000. You will go to your CA who does this. So uska fees dena padega. So therefore the taxable profit that can arise in the future is 48,000. What is your deductible difference? Sir, my deductible difference is 50. So up to what you can recognize? So recognize up to 48,000. Recognize up to 48,000. Okay. So this is what you are having as far as tax planning opportunities are available. Okay. All right. And you will have to reassess or review the DTAs every time, every year. So for example, I have recognized, you'll recognize a DTA because you're having a tax planning opportunity, no? So it is generating profit of 60, for which you have to pay 12. So net profit generated is 48,000. So you will recognize a deductible difference of 48. So the rate is 30%. So 48,000 into 30%. 48,000 into 30%, that gives you 14,400 DTA can be recognized. Okay. In the future, you can generate profits with this tax planning strategy. Okay. So that is what you will check. Achha. Now, because of the nature of DTA, the conditions on DTA, what the standard requires is reassess or review at each reporting date. If there is some DTA you did not recognize, but now you either have a tax planning opportunity or a reversal or profits, then what you had not recognized, you will now recognize. Okay, allow the previously unrecognized DTA to be recovered. Ulta bhi ho sakta hai, I had recognized something in the past, but now profits are not going to come. Now this is not going to come, taxable differences. Neither is there any tax planning opportunity. Pehle tha, abhi nahi hai. Then sufficient taxable it is no longer probable, then reduce the carrying amount of DTA. So what is our tool as auditors, if you are in the assurance field, is documentation. You need to have a documentation of what was done in the past and what is the position now. And you need to review that documentation at each reporting date to ensure that the assessment is in line with what we have assessed previously. Okay, so that takes care of step 6. Assess the assess or reassess deductible temporary differences tax losses, etc. Okay. So coming to the tax rate, sir, which rate do I use? Do I use the current tax rate in force, or do I use the rates which are substantively enacted? Deferred tax is going to be settled in the future, So when it is going to be settled in the future, what happens now is I cannot use today's tax rate. I can use only the future tax rate. Sir, apne kya malum? How do I know what is the future rate? I know not. Today the budget has come. If the budget prescribes a new rate, the budget is effective for financial year running 22-23, right? The budget is effective for financial year 23-24. That is assessment year 24-25. So I do know for sure that what is the tax rate at least in the next 1 year. So I will have to use that tax rate and do the accounting of my deferred tax accordingly. Okay. So what they tell is it is the tax rate expected to apply when the asset is realized or the liability is settled. When the asset is realized or the liability is settled. But if suppose some of my differences are going to happen after 5 years, 6 years, etc. I cannot predict. एक तो neither am I a finance minister. अभी तक वो भाग्य नहीं है मेरे. Neither am I an astrologer who can look into the future and see what is the rate. Okay. So if that is the case, what will I have to look at is based on the tax rates and tax laws that have been enacted or substantively enacted by the end of the reporting period. So before 31st March 23, the budget is already enacted for financial year 23-24 or assessment year 24-25. So if that is the case, then you know what is the income you are going to get in 23-24, and you know that, you know what will be the tax rate for 23-24. So you can use that rate for the purposes of your reporting, Okay. So this is how you will continue. Okay. So okay. So I want you to do this for homework. Simple hai. I want you to do this also for homework. You should be able to solve that. Okay. And I want you to, okay, illustration 2, what I will do is, let me see if I can record this for you. Okay. It has an interest receivable. Something is wrong here. No. A Limited recognizes interest income in its books on accrual basis. For income tax purposes, the method is cash basis. On 31st, okay, we'll do this together. Okay, we'll do this together. Okay. A Limited recognizes interest income in its books. See, I don't have much time. So what I'm going to do is I will skip a break today. I'll be leaving you by 9:45, 9:50 as usual, completing the standard in totality. So therefore, I will be doing these questions right now. We'll do a little fast so that you should be in a position to understand. Okay. So the A Limited recognizes interest income in its books on accrual basis. However, for tax purposes, the method is cash basis. Okay. On December 31, it has interest receivable of 10,000 and the tax rate was 25%. Okay. On 28th February 20X1, the finance bill is introduced, and in the finance bill, you are having the legislation that the tax rate changes to 30%. The finance bill is enacted as an act on 21st May 20X2, discuss the treatment of deferred tax. in case the reporting date is 31st December X1 and these are approved and for issue on 31st May X2. Okay, so this is what you are going to recognize. All right. So now, one second. Yes. So now let us come on to this particular question. Let us see. See, first of all, carrying amount. Carrying amount is 10,000. Carrying amount is 10,000. I think the question numbers may not seem coherent, but doesn't matter. Carrying amount is 10,000 and your tax base is 0. So because I'm recognizing it on cash basis. So does it give rise to a temporary difference? Yes. Is the carrying amount more than the tax base? Yes. Carrying amount is greater than the tax base. Okay. So that gives rise to a deferred tax liability. Okay. So as on 31st December 20X1, 10,000 into 25%, ideally my DTL should have been 2,500. My DTL should have been 2,500. Now on 28th February 20X2, this should be 20X2. On 28th February 20X2, the finance bill is introduced in the legislation that changes the tax rate to 30%. This bill is enacted on 21st May 20X2. Will I change the deferred tax liability to 3,000 is the question. Should I record a DTL of 3,000 or should I keep it at 2,500? That is the question which I will have to answer. Answer is, as on 31st December, did you enact the legislation? Answer is no. Did you have the budget as on 31st December? Answer is no. So neither was it enacted nor was it substantively enacted. So therefore, will you change the DTL from 2,500 to 3,000? Answer is no, you will not. But sir, the enactment has happened before they were approved for issue. To kya hua? You are preparing your financials for the year 31st December. As on December, you will have to check the conditions, not as on the date when you are approving it for issue. See, the condition should exist on the reporting date. ये तो वही बात हुई जो हम Ind AS 8 में पढ़ते थे. What we were studying in Ind AS 8. See, a fire has happened after the balance sheet date and that has caused a huge loss to the company. So should I adjust my books as on the reporting date? Answer is no. अरे आग reporting date पे कब लगी थी? The fire did not happen on the reporting date. It happened after that. It is not an adjusting event. It is a non-adjusting event. If it is significant, give a disclosure. But you cannot adjust the books because the event happened after the balance sheet date. Similarly, here also, the event has happened in 28th February. After 2 months of the closing date. I'm not in March, I'm in December. Okay. So December closing में the legislation का तो भनक भी नहीं रहता है. दिसंबर में किसको मालूम रहता है? बजट का चर्चा तो जनवरी लास्ट वीक से शुरू होता है. Even news channels start talking about the budget after 15 February. You will never see a news channel discussing the budget in December. Even if you go to the government and ask, government will say 1.5 months is there, come to me in the month of Feb. So therefore, neither the budget was enacted, nor was it substantively enacted, nor was the budget held in December. So therefore, do I have to make the change? No, I will not make the change. But if the change is material, then you can give a disclosure. If the change is material, you can give a disclosure. This is page 10.58, illustration 7. Okay. तो ये हो गया मेरा illustration. Okay. Distribution of dividends. Okay. Measure it at the rate applicable to undistributed profits. Measure it at the rates applicable to undistributed profits. Okay. So I leave this for homework. All right. Calculate and recognize the deferred tax. Well, apply the tax rate to the temporary differences to arrive at deferred tax liability or deferred tax asset. No discounting of deferred tax assets or deferred tax liability. Sir, future may settle or it is getting settled after 3 year, 4 year, 5 year. Are you sure about the settlement? No. Already we are recognizing something which is notional. Please don't make it more confusing by discounting it, because notional figure ka discounting karoge, that discounting will already end up being notional, and therefore we will not recognize it based on a discounting. Even though it is settled in the future, we are going to treat it as what? We are going to treat it as a current value recognition only. No present value. No present value. Okay. So that is one part which we will have to understand. Okay. Tax rate based on laws enacted, substantively enacted, and DTA shall be reviewed at the end of each reporting period. Always remember DTA. Practically also I am telling, tomorrow when you become the auditors, or now if you are doing the audit of companies, whenever you see a DTA, question, double question, be skeptical. Even if your principal shouts at you, bolo standard mein likha hai, keep the documentation. Particularly if you are doing the audit of large entities, public limited companies, listed companies, be doubly careful with DTA. Okay. All right. Accounting for deferred tax, we have seen this. Recognize in OCI, SOC, statement of changes in equity, or in the P&L, as the case may be, where the original impacts have gone. Okay, where the original impacts have gone. Sometimes you may have changes in DTA or DTL, even if there is no change in the temporary differences. What are those cases? Well, there could be a change in the tax rates. If that question, the tax rate was changed in December, then I would have to change 2,500 to 3,000. I would have to take a 500 impact in my P&L, even though the temporary difference has not changed. So that is one thing. Second thing is reassessment of recoverability of deferred tax asset. That is one which you will have to check. And finally, change in expected manner of recoverability of the asset. So when this is the case, you are going to recognize it in the P&L unless the transaction is outside the P&L. So when you pay dividends to the shareholders, sometimes you will have to pay some tax. There was a dividend distribution tax earlier. Now it is not there. So where are you going to record it? Not in P&L, but you would be charging it off to equity. You would be charging it off to equity. Okay. So this is about accounting. Can you offset if there is a legally enforceable right and an intention to settle on net basis? You can do the offsetting of DTA and of current tax assets and current tax liability. So basically this is nothing but provision for tax versus TDS, TCS, advance tax. You are setting this off. Okay. Is it permitted? Yes. Is it mandatory? Yes, if you are settling it on a net basis, and we always settle it on a net basis. So if you look, many times I have seen balance sheets where provision for tax is there and assets and liability and tax assets are also there. TDS, TCS, advance tax, etc. Net it off. Net it off. Even if you are doing the books of a proprietor, even if you are doing the books of a partnership firm, of an LLP, of a company, these offsetting principles are always applicable. AS 22 applies to all entities regardless of the size. So therefore you will have to do the offsetting there as well. Okay. Deferred income tax, you can do the offsetting when current tax can be offset by the same tax authorities. So suppose you have a deferred tax asset in Sri Lanka, a deferred tax liability in India. Can you offset? Answer is no. So you will have a deferred tax asset for Sri Lanka also appearing, deferred tax liability for India also appearing. So these were small steps which were there. Okay. Business combination we have discussed already. Yes. It affects the goodwill or bargain purchase gain recognized. We have seen that already. Okay. Difference gives rise to a DTA, DTL, whatever it is. Okay. Recognition principles for deferred tax. Okay. Potential benefits. All of this we have discussed it. Okay. Income tax loss, carry forwards, all of this under the business combination. So pre-acquisition DTA, all of it you will have to reassess. Okay. Reassess. That's it. Okay. So go through this. It's simple. Okay. So now let us come to solve this particular question. Okay. ये थोड़े से important questions है, so we can discuss the questions, and we are almost done. We are almost done with the questions. Okay, so now coming to question 2, RTP. PQR Limited, a manufacturing company. One second. Can I push this for you for homework? PQR, a company, prepares consolidated financials. Okay. Capitalized it. Okay. All right. Let us do this. No problem. Okay. PQR Limited, a manufacturing company, prepares consolidated financial statements to 31st March. During the year, the following events affected the tax position of the group. So what is the tax position of the group getting affected? QPR Limited, a wholly owned subsidiary, incurred a loss. Subsidiary incurred a loss adjusted for tax purposes 30 lakhs. QPR is unable to utilize the loss against previous tax liabilities. Income Tax Act does not allow QPR to transfer the loss to other group companies. It allows QPR to carry the loss forward and utilize it against the future taxable profits. Directors of PQR do not consider that QPR will make taxable profits in the foreseeable future. Do not consider that QPR will make taxable profits in the foreseeable future. So tell me, can I recognize a deferred tax asset on this? Can I recognize a deferred tax asset on this? Is 30 lakhs going to be an asset? Yes, it will result in a saving in tax in the future. But you tell me, can I recognize a deferred tax asset on this? Can I recognize a DTA on this? No, because there is no profit. So do not recognize DTA. Do not recognize DTA. All right. Next. Okay. During the year ended 31st March 20X8, PQR Limited capitalized development costs which satisfied the criteria as per Ind AS 38 intangible assets. The total amount capitalized was 16 lakhs. The project development, the development project began to generate economic benefits. From which period it began to generate economic benefits? From 1st January 20X8. The directors of PQR Limited estimated that the project would generate benefits for 5 years from that date. Development expenditure was fully deductible against taxable profits for the year ended 31st March 20X8. So you should be in a position to help me. See, I am in the year 31st March X8. So now what I will do is 16 lakhs. I will be depreciating for 5 years for 3 months. So this is going to be my depreciation. Correct? So 16 lakhs divided by 5. 16 lakhs divided by 5 divided by 4. 80,000 is the depreciation for financial reporting. So carrying amount is 15 lakh 20,000. Tax base is 0. It is entirely deductible. So tax base mein I'm not recognizing an asset, it's fully deductible. So carrying amount is greater, so there will be a DTL 15 lakh 20,000 multiplied by the tax rate. Have they given the tax rate? 30%. So 15 lakh 20 into 30%. So that gives you how much? That gives you 4 lakh 56,000. 4 lakh 56,000. Okay, fair enough. See, tax base is 0 because they've told no, the expenditure was fully deductible against tax profits. That means what entry you will pass? Development expenditure account debit to bank in the tax books. So it means in the tax books, asset nahi rahega. It's fully written off to the P&L. So tax base would be 0. DTA is not recognized since there is no virtual certainty. This provision is, it is there in AS22. Yes, it is there in AS22. Okay. So ye ho gaya mera question 2, part 2. On 1st April, PQR Limited borrowed 1 crore. Cost to PQR for arranging was 2 lakhs. This cost qualified for a tax deduction on 1st April 20x7. The loan was for a 3-year period. No interest was payable, but the amount repayable will be 1 crore 30 lakh 43,800. This equates to an effective annual interest rate of 10%. So now as per Income Tax Act, a further deduction of 30 lakh 43,800 will be claimable when the loan is repaid on 31st March 20x7 plus 3. After 3 years. Explain how each of these items would affect the deferred tax. Fair enough. So this last one is going to be your, what you say? This last one is going to be your financial instruments. Okay. So carrying amount of the loan is going to be how much? 98 lakhs. Plus 10% effective rate of interest, 1 crore 7 lakh 80,000. Tax base is 1 crore. So you will be having 7 lakh 80,000. So carrying amount is greater than the tax base of a liability. So you will have to create a deferred tax asset. DTA 7 lakh 80,000 into 30%. So this will be 7 lakh 80,000 into 30%. So that gives you 2,34,000. 2,34,000 DTA. How did I get carrying amount? See, 1 crore is the loan. To arrange it, you paid 2 lakhs. So 98 lakhs is the net proceeds which you've studied under Ind AS 32. Plus 10%. So this gives you 1 crore 7 lakh 80,000. For tax purposes, it is 1 crore only. So you are having a deferred tax asset because carrying amount is greater than the tax base. Okay. So share-based payment transactions, you can just go through it. It's theory. Okay. Change in tax structure is theory. I don't have much to explain, and go through these disclosures. Okay. Disclose components of expense, tax related to items charged directly to equity, explanation of relationship between taxable income and tax profit. I want you to check these 2 questions. Okay. These 2 questions here. And this 1 question here is what I am going to do right now, but I'll just run you through the disclosures first. Change in tax rates, unrecognized deductible differences, temporary differences with investment in subsidiaries, DTL, DTA income expense, dividend tax, business combination, discontinued operations, and the evidence of future taxable profits. distribution of dividends, contingencies, change in tax rate or tax loss. So that's it. Do this one question for homework. It's manageable. What I'm going to take you through right now is the change in the tax, or not change in the tax rate. I'm going to take you through the reconciliation that we are going to give. Okay. So go through this question. It's an important one. It's come recently in the RTP. Most important, why? It is because we have to give this reconciliation. Okay. So following is the summarized P&L of Earth Limited as per Ind AS. So you are having revenue, profit before tax, and you are having tax expense, profit after tax. Additional information: rate applicable is 30%. Other income includes long-term capital gains of 10 crore, which is taxable at 10%. Other expenses include the following items not deductible for tax purposes: penalties, impairment of goodwill, CSR expense. Other expenses include R&D expenditure of 8 crores, in respect of which 200% weighted deduction is available. Other income include dividends of 4 crore exempt from tax. Profit before tax of 594 crore includes agriculture income 55 crore exempt from tax. Profit of 60 crore earned in US, on which Earth Limited is required to pay tax at 20%. Depreciation as per income tax laws is 25 crores. During the review of the financial statements, the CFO वो यही काम कर सकते हैं, multiplied profit before tax by the tax rate, arrived at 178.2 crore as the tax expense. However, actual income tax appearing in the summarized statement is 166.9 crores. CFO has sought your help in reconciling the difference between the two tax amounts, expense amounts. Prepare a reconciliation. So very simple. See, we start with 594. Okay, I will draw it here. Okay, you can take a note later on. I'm in a little bit of hurry. That is why I am just proceeding. Accounting profit is 594. Tax at the rate of 30% thereon comes to 178.2. So this is what is going to be the tax. But the tax is 166.9. So now we will have to give a reco. So non-deductible expenses. Non-deductible expenses. How much is that? 44 plus 6, 50 plus 1, 51. So obviously 51 crores into 30%. This is going to be 15.3 crores. This is going to be 15.3 crores. It is a tax question only. Pata nahi, institute also has asked this. Okay. All right. Next one, R&D expense. आपको एक्स्ट्रा डिडक्शन मिलेगा. You are going to get extra deduction. कहाँ गया वो R&D? 8 crore into another 30%. 8 crore into 30%. Original 8 crore is already gone as a deduction. So 2.4 is what you are going to get. Acha. Exempt incomes. Dividend plus agriculture. So total is how much? 55 plus 4, 59 crore. 59 into 30%. So that gives you 17.7. Next, long-term capital gain. 10 into CFO ने 30% multiply किया, but it is subject to only 10%. So incremental rate of 2. And same goes for US income. US income 60 into 30% he has multiplied, but you are taxed at 20%. So extra is 6. So when you do this add less, you should be getting 165.4. which is this figure 165.4. Okay, so it's largely a tax question, nothing accounting is there here. Okay, so tax expense, current tax expense. Okay, and finally deferred tax. Deferred tax, you are having depreciation as 30 here, and for the purposes of income tax it is 25. 30 minus 25 into 30%. So this is equal to 1.5. This is equal to 1.5. Okay, so 165 plus 1.5 gives you 166.9. Okay, so very simple question in that sense, but I had to do it. See, here I have to go by profit figure because I am not given the balance sheet data. Because I am not given the balance sheet data, मेरे पास कोई option नहीं है. So therefore I have to go by the profit figure. But ideally it is not correct. Okay, if I go strictly by the words of the standard, it is not right. But question है, question भगवान के बराबर होता है. So we have to go according to that question. So therefore we cannot go by the profit figure. Okay, so now that takes care of all your standard as a whole. What I want you to do is, see, out of curiosity, I am just asking you, we had done this question, right? I had given you this extra question. You have already computed the deferred tax impact. We are getting a net liability of 8,51,200. What I want you to do is prepare a tax reconciliation. Prepare a tax reconciliation of this question. As far as I remember, in this question, we are given the profit and loss also. Correct? If you see, it is a series of questions. Okay, so I am given the profit and loss also. So 59,50,000 into 30%, I should get 17,85,000. But I have recorded 28,14,000, and then this deferred tax impact also I have given. So what I want you to do is, for this question, current tax, deferred tax, you have already calculated. Okay, total tax expense. Map 59,50,000 into 30%. That will be the tax rate, tax rated expense. Try to present a reconciliation for this. Try to present a reconciliation for this. This should by large give you a beautiful understanding of the entire chapter. इसमें सब कुछ है. Government grant है which is excluded. I have explained that. Taxable differences, temporary differences, subsidiary investment, sab kuch hai. There is practically everything what we have studied. So what I want you to do is do a reconciliation and present it to me. Okay, you can mail the reconciliations at fr-final@icai.in. Try to present this reco to me and submit it to me on this mail. Yaad rakho, I'm waiting for this reconciliation. Okay, I'll be waiting for these reconciliations. You can freely submit it. Okay, doesn't matter. Even if you somebody reads it, it's just a student submitting a document to a teacher. Okay, you don't worry. But please submit this. Please do it. I want you to go through it, because then you would have covered DTA, DTL, reconciliations, this, that, everything in totality. You can also present it in Excel and submit it to me. I'm fine with that. But I want you to give this to me so that you know how the actual workings happen. Okay. So with that, we conclude our discussion on deferred tax. I hope the sessions were clear to all of you. Kaushiki, Soham, everyone. Yes, Manini, Shailendra, Viraj, who all are watching. I hope the sessions were quite clear. And if there is any doubt, you can always write to me. Okay. But I have given you that extra question. Do that. And we meet up on 21st now with a very small chapter, that is corporate social responsibility. I guess then the batch is coming to a close. Okay. I am requesting the institute to update the Triple C lecture. I have recorded it earlier, so I will ask for them to upload that lecture. Okay. ये standard बहुत भारी है practical life में भी. Okay. It's huge in practical life also. ओके समझ में नहीं आता है कैसे अप्लाई करना है, बट करना पड़ेगा, है तो करना पड़ेगा. ओके एनीवेज, थैंक यू एवरीवन, टेक केयर, स्टे सेफ एंड सी यू ऑन ट्यूसडे. ओके, सी यू गाइज ऑन ट्यूसडे. ओके, थैंक यू, बाय बाय, टेक केयर. ओके, यस, do the homework questions without fail. Okay, do the homework and do the questions. Okay, all right, thank you, see you.